to this webinar this morning. My name is Mark Spence. I'm Managing Director of Construction Employers Federation, and we're very pleased this morning to present with our patrons, Willis, Watson, this webinar on trade credit insurance, which is a very important topic and increasingly so in current circumstances. I'm just going to explain the house rules, if you like, for the webinar for a moment or two before introducing our speakers. We're using Zoom this morning. We are recording this session just so that you know, and that's so that we can make it available to people who are not able to attend, or you can share it later with colleagues. The process this morning is we have three speakers who will be speaking for around about 10 minutes each, and we will take questions and answers at the end. The way we're going to do that, if you look at the bottom of your screen, you'll see a Q&A button, and at any stage during the webinar, please submit your questions through that. They are anonymous, and I will be sweeping up questions at the end and asking them on your behalf. So please feel free to ask any questions that you like, and our speakers will be very pleased to pick those up. If there are any issues during the presentation that you want to follow up later, please do drop me a chat through the chat function at the bottom of the screen as well. I'm going to introduce now our three speakers. We're very pleased, as I say, Willis, Watson, who are patrons of the CEF and support our members throughout the year. We're providing this information today, and maybe the first of a series of webinars on specific topics. Today, Nigel Birney, who's Head of Trade Credit and Surety for Northern Ireland for Willis, Watson, will be speaking to us. And then his colleagues from Atradius Insurance, who are market leaders in credit insurance across the UK and Ireland. We have Kevin Knowlton, who's Senior Construction Underwriter for the UK, and Fran Sowen, Senior Construction Underwriter for Ireland, who will both be speaking to us on issues closer to home. So as I say, with no further ado, I'm going to hand over to Nigel and let him begin his presentation, and we look forward to questions and answers later in the session. Thank you.
Well, good morning, everyone. And on behalf of Willis, Watson, I would just like to echo what Mark has said and thank you all for taking the time to join our webinar this morning. I'd also like to thank and extend a special thanks, in fact, to Mark and his team at the CEF for hosting this morning's webinar. It's fantastic that over 100 people have registered. This is the first time I've presented in a webinar type situation, so please cut me some slack. It's a bit nerve-wracking knowing so many of you are out there, but I really hope you enjoy the presentations, and most of all that you take something away with you that makes joining in our call this morning worthwhile. By way of introduction, I head up the Trade Credit Division at Willis, Watson in Northern Ireland. We are the largest specialist on the island of Ireland with around 65% of the brokered business. Between our Belfast and Dublin offices, our clients have a combined turnover of around 12 billion, and a very significant portion of this is in the construction sector. So we have considerable experience in dealing with issues that are peculiar to the construction sector. You may be aware that last June, to help businesses trade through the pandemic and beyond, the UK government, like many other European countries apart from the Republic of Ireland, put in place a £10 billion reinsurance guarantee scheme for the UK's credit insurance market, as we realised that the availability of trade credit was pivotal as we look to reinvigorate, revitalise and rebuild our regional economies across the UK and also in the Republic of Ireland. Now, I'm sure everyone on today's call is most likely aware that fundamentally, credit insurance provides protection against bad debt whenever a customer defaults on payment. However, there are a suite of benefits associated with credit insurance. Many banks and commercial funders see credit insurance as a very acceptable collateral when considering funding requests, and access to working capital facilities could well be a lifeline for many businesses once the governments in the UK and Ireland decide to withdraw the various state aid support packages that are currently available and on which many businesses are dependent on. I suppose Brexit is also something that many businesses are wrestling with at the moment, and many are being forced to look at new markets. And again, through the market intelligence that underwriters such as Atradius can provide, this enables businesses to target new creditworthy customers, which hopefully lead to profitable relationships. Most major credit insurance underwriters also provide an integrated debt collection service with debt collection and legal costs borne by the insurer for insured debt. And we've seen many times where one of our clients is struggling to get paid, but when the big bad insurer comes knocking on the customer's door, all of a sudden the debt is paid. So credit insurance is not only a risk management tool, it's also a cash flow tool to help get invoices paid and money back into your business as quickly as possible. And as I say, the turnover is vanity and cash is certainly sanity. Now, despite the UK government support for credit insurance sector, one of the biggest challenges for underwriters and credit insurance underwriters is the flow of financial information to them, or sadly, the lack of it, from businesses to enable underwriters to keep existing cover in place and also to create capacity to write new cover and increase their exposure in all sectors, including construction. And this particular issue is something I just want to focus on for a few minutes and explain what impact this can potentially have on construction businesses in every part of the supply chain, whether in Northern Ireland, GB, or the Republic of Ireland. Because of the damage COVID has inflicted and is continuing to inflict on the economy, underwriters like Atreides are monitoring very closely sectors and businesses deemed vulnerable to the impact of COVID and also the impact of Brexit now as well. Sitting here the 17th of February 2021, and given the unprecedented downturn since this time last year, it's, as you can imagine, it's impossible for underwriters to assess the current financial health of a business based on, say, December 19 accounts, which, for regulatory purposes in the UK are the most recent that must be filed. And the recent announcement by Companies House in the Republic of Ireland, CRO, that they are extending the filing period for December 19 accounts until the end of May this year has exacerbated that situation and created a very major problem for underwriters. As in the current climate, 2018 accounts are understandably deemed too old for underwriting purposes, despite not breaching any regulations. And this delay in filing will unfortunately lead to the suspension or cancellation of cover until updated information is available. And that's the reality, unfortunately. So due to the circumstances that I just mentioned, we are strongly advising businesses in every sector, including the construction sector, to take proactive action to protect your own credit rating with credit insurance underwriters in order to maintain your credit lines and prevent the potential for supply chain disruption. If cover was withdrawn or reduced on your business, apart from the reputational damage it could cause, it could mean reduced supplies, resulting in unfulfilled or delayed orders, which could possibly result in penalties. It could also mean unwanted pressure on cash flow if suppliers insisted on being paid up front, which is probably, when you think about it, which is probably the action you may also be forced to take if you have credit insurance and cover is withdrawn on one of your own customers. I think it's fair to say that Irish companies, both north and south, are traditionally very well known for their reticence and reluctance to provide regular financial information to underwriters, and maybe somehow see this as self-harming almost, unlike businesses in GB who view this as a standard practice, which Kevin will no doubt confirm. Now, that being said, recently we have seen more willingness by businesses to provide information, but there's still quite a way to go. So the reality is that if there's a lack of information and transparency and companies do not provide information to underwriters, either proactively or when they are requested to do so, then underwriters will be left with no choice but to withdraw cover due to the massive uncertainties caused in the last 12 months by COVID and now Brexit. So what information should you consider providing to underwriters? It's very important, I suppose, at this juncture to say that all underwriters are very happy to provide non-disclosure agreements, so that that's to protect the confidentiality of any information you provide to them. The most common information that businesses provide on a regular basis would usually include management accounts, details of banking facilities, including working capital facilities, along with details of headroom in such facilities, projections, pipelines, order book, age credit report. And underwriters are also keen to understand what actions you as a business have taken to offset or limit the potential negative impact on your business caused by COVID or now Brexit, or a combination of both. Or simply pick up the phone and talk to an underwriter. Any of all of these actions will enable underwriters to make more informed decisions about your business and apply the most equitable credit rating. Finally, how can we at Willis Towers Watson help you and your business? Well, Willis Towers Watson Trade Credit have access and relationships with every credit insurance underwriter in the market in both the UK and Ireland, and our credit rating service facilitates the distribution of information to every underwriter. On an ongoing basis, we will provide advice and guidance on what information to give, who to give it to, and when it should be given. And when necessary, we can arrange direct meetings with underwriters, as in many cases, there can be a story behind the figures, and that the underwriters need to understand. So engagement is the absolute key. Over the last 12 months, we have worked with a number of companies, some of them on this call today, who can testify that this approach with underwriters does work. Finally, if you have any questions you would like to ask me, please use the question and answer session that Mark explained how to use at the outset. You have the option at the bottom of your screen, and I'll be delighted to respond in the question and answer session which follows the presentation. So please don't be shy. We want you to get as much information out of this webinar as you can. On the other hand, if you'd like to discuss credit insurance for your own business or how our credit rating service could help, please don't hesitate to contact me over the next few days, and we'll be delighted to provide you with some options and solutions. I'm now going to hand over to two very senior and experienced construction underwriters from Atradius, Fran Salmon, who is based in Dublin, and Kevin Naughton, who is based in Cardiff. Fran and Kevin are going to provide you with some detailed insight into their underwriting view of the credit risks facing the construction sector across the UK and Ireland in the short to medium term, and also what Atradius's underwriting strategy is for the sector, the construction sector in 2021. So thank you for your attention, and I'm now delighted to hand over to Fran Salmon.
Good morning, everyone. Thanks, Nigel, for the introduction. My name is Fran Salmon, and I'm the senior underwriter for construction in ROI and NI. Just a bit of background, Atradius has had a presence in Ireland since 1992. We provide credit limits and analysis on more than 10,000 businesses, and our total exposure to the Irish market is more than 4 billion. Of this, 15% approximately is in construction, covering approximately 2,100 buyers. Over the last number of years, I suppose last 8 years, we've been growing our exposure to the construction market steadily. And as we move on to 2020, it's clear that the construction industry was negatively affected by the first lockdown, when all but essential work was halted between March and May. And the Ulster Bank PMI, which is an indication for construction activity, fell to just 4.5 in April, when anything below 50 represents a contraction. At that time as well, approximately 86% of construction employees were relying on state support to pay their wages. The lifting of restrictions did mean that the sector closed out 2020 in expansion mode. Rising workload saw the PMI increased to 53.5 in November and 52.3 in December. There was a sharp rise in housing activity and also in purchasing activity, with stockpiling ahead of the Brexit transition period. We certainly seen that in the amount of applications for cover on Irish companies from our UK customers at that time. Moving into 2021, I suppose the new restrictions imposed in January meant that most construction work started on a weak footing. There's certainly been a lot of lobbying for all construction sites to reopen from the 5th of March, and we wait to see on that. In terms of I suppose going forward, the output is really going to be affected by the continued lockdowns, the pace of the vaccine rollout, which is very slow in the Republic of Ireland compared to that in the UK. And also the restrictions on site due to social distancing, and it's obviously going to impact how the efficiencies, site efficiencies, I suppose. Within the subsectors of construction, we're definitely seeing the builders merchants are recording strong figures just in the management numbers that we've received throughout 2020. That once lockdown eased, they were seeing very strong numbers, as the repair and maintenance and the house building sectors proved robust, and we think that's likely to continue as people. It's unlikely that people are going to be going on holidays this year, so again they'll be doing house improvements, and also the working from home will continue. In the private sector, we've noticed that there's been delays in investment rather than cancellations, with a lot of work being moved from 2020 into 2021. I suppose private investments in sectors such as data centers, as well as industrial logistics and storage, is continuing strongly. Capital investment in your commercial and hospitality, which has been very strong in recent years, is likely to see a drop in 2021, just purely with the amount of offices and hotels being built. And retail as well, we would see that going to struggle, with how many the move to online, away from your bricks and mortar retail. In the budget in 2021, the Irish government announced a sizable stimulus package around transport, roads, school building, and hospitals, and this is likely to be a boost for civil engineering contractors, which I suppose over recent years there's been very little civil engineering investment in the Irish market. So while that is all quite positive, in Atradius in Ireland, construction was the sector that had the highest value of claims paid and the second highest volume of claims received in 2020. And we would anticipate that in Q2 and Q3, that the rate of insolvencies will rise as government supports come to an end. It was interesting, at the end of 2020, an insolvency practitioner, Baker Tilly, said the number of inquiries that they were seeing about examinerships and restructurings was at a 30-year high. And while some of these may be in the sectors most impacted by COVID, such as hospitality and retail, construction is always one of the sectors with the largest number of insolvencies. So we definitely expect to see insolvencies in construction increase in 2021. I suppose overall societal issues around housing shortages, hospital capacity, should drive the construction industry forward over the coming years, along with the presence of the large multinational corporations who will continue to expand their operations and invest in new facilities, mainly across the technology and pharma sectors. If we could move on to the next slide. It's a very similar picture, I suppose, in terms of the Northern Irish construction sector. Northern Ireland's construction collapsed by 30% at the height of the coronavirus pandemic, but rebounded and hasn't been impacted by a second lockdown. There's certainly been delays we've heard speaking to companies delays in supply chains as a result of COVID and Brexit. In terms of Brexit, there's the customs checks and bureaucratic hurdles, which have certainly hampered the supply from Great Britain to Northern Ireland, with Great British suppliers just unprepared or simply unwilling to supply into the NI as they feel it's just increased costs and it's a small market. In saying that, there is a positive side in that, you know, companies in Northern Ireland could be at a competitive advantage as they can import from the EU on the same terms as before, while rivals in Great Britain just cannot. And despite these challenges presented by COVID and Brexit, construction in Northern Ireland is one of the better performing sectors at the moment. Certainly, we see housing to be key for the growth in the industry in 2021, as demand remains strong as the population of Northern Ireland continues to grow. Again, like we've seen in the Republic of Ireland, construction and construction materials, while accounting for 20% of our exposure, covering 700 buyers, it still accounted for 49% of our losses in the trade in Northern Ireland in 2020. We move on to the next slide, and just to, you know, reiterate and you know, again, focus that on what Nigel has said, information for underwriters is vital. Nigel mentioned there that the CRO extending the filing arrangement, it means we are supporting cover on businesses at the moment where the latest accounts we have are 2018. And that's just not a place that we can, as underwriters, can be comfortable with. So, you know, it's clear that we need more up-to-date information. And I think companies can help themselves by supplying the information to a trader, it's either to an underwriter directly, such as myself, or to the customer services department. Again, open dialogue is key, providing management accounts to underwriters. As Nigel mentioned, we can provide non-disclosure agreements, that's no problem. You know, management accounts, you know, being on a quarterly or even on a 6-month basis is very helpful for us to get an understanding of how a business is performing. Banking facilities, what support, you know, your order book, your current work schedule, forecasts for the coming year. It's all information that we think is vital for us to have a better picture of a company. Also details on key suppliers. We will find that we could have a lot of cover on a company that's not being in use, and it's important to have the cover where it needs to be, and providing details of who the company's key suppliers are is vital. We also would have done a lot of one-to-one visits, and there, I suppose, in the current environment, being replaced by Teams calls. But again, this is information that is, you know, you get to speak one-on-one with one of the key people in the business, and it gives you a better understanding of the business and the strength of their management team. And that's really finishes my segment, but I'm happy to answer any questions anybody will have at the end of Kevin's slides. I'm just going to pass over to Kevin now for his take. Thanks.
Thanks, Fran. As you may see, sorry about what's happening to the background here. I don't know where my fancy Atreides thing has gone. It's just and there was a thing in the top right hand corner called view, which I've been trying to push, but I'm thinking I'd better leave it alone. because I don't know what's going to happen. So if anyone from a trader is watching this, please don't grass me up, as they say. Thanks for attending. Thanks for the opportunity to speak. I mean, circumstances dictate that we can in this format rather than visits. So, like I say, thanks for the opportunity. I'll try not to cover, because there's a lot of similarities between what Fran and myself will be discovered, have worked out. And so I try not to present, it'll be too similar, and try to probably keep the nuances of what I know, which is UK. I come from ECGD days, so hence my IT knowledge is pretty hopeless as to where I can fix my screen. But that's the background I have. Construction there for many years, working from one slum to another. Anyway, for what it's worth, for once in our lives in a construction team, the COVID situation, probably there's less impact than some of my colleagues in entertainment, retail, dining, travel, and we're on the back burner, which is a different place to be on the construction side, because as I'll go on to, construction is in the UK a credit insurance product because of the amount of claims and volumes we have and have had over the last 10, 20 years. Anyways, just quickly going back to what happened in March, everything shut down. So as I say, 41% drop. But subsequent lockdowns have been totally different. Construction, because of its importance, is basically allowed to operate. The first lockdown did cause issues and be shut. So we're looking at turnover severely affected for 6 weeks at least, and much more for some others. So hence, going back on the note that both Nigel and Fran made about information, that would be imperative for us going forward. In the UK, it's not so much of an issue. We do have relationships with many, many thousands of buyers, and generally they're willing to provide information. Only a few, and it's a very few, that won't. I mean, going forward, bear in mind that companies are bound to be producing accounts now, which will show possible losses because of the total drop in turnover against a situation where they have fixed costs in place, is that the amount of information or the information we get is going to be imperative. Understanding what they've done to withstand the pandemic, but also, more importantly for us going forward, as to what they will be able to achieve in 21-22. The sector, as I mentioned, in the traders in the UK, for time immemorial, we have 10, 12, 15% of exposure, but upwards of 25% of all claims paid, which shows you that it's one of it's most intensive in of claims paid for us. Adding solvency figures in the UK, construction always figures highest. It's usually there with services second and other third. The pandemic, as I said before, it's been one of the sectors that's been robust. And since speaking to many buyers since, mid-year, say, last year, things are back to boom because spend has been going on, particularly in builders, merchants, and house build. Going forward, the March end to Help to Buy and stamp duty holiday is creating some angst within the industry, but pleased to see the Help to Buy has been extended this week, another 2 months. Key going forward again in 2021 will be the private sector spend and infrastructure spend, which I'll probably come on to. And hopefully the estimate we get from the national press is that they'll expand 2.7% in the construction industry in 2021, following the decline of 5.6% in 2020. Brexit, I'll just sort of concentrate on Brexit and COVID a little bit, and then maybe just round up where we're going for 2021 and how we look at risks. Brexit, again, has not had the massive effect that we thought we might have. In the UK, a lot of work is UK-centric, so whilst there's some materials, particularly timber, for instance, comes from outside of UK, the actual impact has been negligible. The more so is on labour, as you can imagine. A lot of labour has either returned to their home countries in Europe and not come back, or chose to go back because of Brexit. So there is an impact there. Probably the other impact we have is is an investment that's, you know, in the City of London particularly. But whilst we've seen some major companies move, the movement hasn't been that great. And on bigger contracts, or bigger, sorry, I should say, projects, spend has been delayed more than cancelled. And only this week, there's another big building going up in London with massive amount of money from the Far East. So again, that impact has been fairly negligible for us. On COVID, if you'd like to push over one, Mark, please, thank you. Due to the restrictions that we all know, that's going to be, you know, there's going to be, there will be some issue on output. But again, as I said before, particularly builders mentioned, most companies I've spoken to have announced and seeing far better output and volumes coming back to the market than they thought, and hence they're very busy. What we're also seeing is that obviously the government support schemes would help, and it has helped, and that's why insolvencies at the moment are the record low. Now, if I dip around a bit, what we anticipate there for Q2, Q3 is that as that government support ceases, we do expect to see an increase in insolvencies, particularly at the lower level, where companies who might have experienced problems, you know, in the normal market and have been helped avoid by the government schemes, once they're finished and once they have to be repaid, they could bring problems to their cash flow. And we anticipate an increase in insolvency, should I say. There's also something else in the UK, which is again causing some problems with the lower level SME type companies, where VAT, which they normally would pay back, charge the customer and pay back in time, is now being reversed. So the contractor or trader will not charge VAT. The VAT will be paid by the customers receiving the service. And it's estimated that's a 20, well, as we know, VAT is 20% drop in cash flow, which companies over the years have relied on, in the knowledge they will be paying it back, but at least at the moment or at the time, they have this 20% buffer. This is suspected to be ceased again. It was extended to end of March, but so far it looks like it's still in place. It's a construction-related issue where it's based upon fraud. So just finishing off really, whilst there are a number of points to say it could be a difficult couple of months for construction, on the plus side, we have seen a lot of bounce back and a lot of spend. What we're seeing in is hopefully, which will sustain it, is increase in public infrastructure spend, and projects such as Thames Rail, HS2 and Hinkley are massive projects which will invariably help the industry. Just as a note to what we've seen in the last couple of years in the UK, it's a lot of private equity spend, particularly into builders merchants, and even so, more so than, you know, we just noticed that Wolseley being let go by Ferguson, and Wolseley now are owned by private equity. It's the last 2 years, it's about at least half a dozen big deals being made. Obviously, hopefully private equity suspect there's money to be made in the sector. But hence, you could say it's another reason for credit insurance, because these private equity boys certainly increase the debt on the balance sheet and have their own nuances. I'd like to say thanks again for the opportunity to speak. If there's any questions, feel free. Sorry about the background, like I said.
Thank you very much. Thank you very much, Kevin, Brad, and Nigel. As I say, if anybody has any questions, do raise them. We have a couple already. I think I'll take these in order. So hopefully, I think this one should sit with yourself, Nigel. If you could just unmute there, Nigel. So, Nigel, first question, I think your mute is back on, unfortunately. The question is, can credit insurance cover supply and fit contracts or just supply only? Just on mute there, Nigel. Sorry. Bottom left of your black bar there, Nigel, just to Now,
Okay.
so can credit insurance cover supply and fit contracts or just supply only?
Simple answer is yes. Credit insurance can cover both supply only and supply and fit. In fact, most insurers have a tailored credit insurance policy to cover the, I suppose, the peculiarities and nuances in the construction sector, such as applications for payment, retentions, final account balances, off-site costs. So, underwriters do recognise that it's not just like selling tea bags, the construction sector. You have all sorts of peculiarities that need to be catered for. So that's why all or most underwriters, including the Tradius and the other big players, do have specific policies to cover those types of peculiarities that I just mentioned.
Okay, thank you. And I think this might be for you again, Nigel. Can credit insurance cover customers outside of the UK and Ireland? So obviously some people on the call looking to Europe and abroad.
Yeah, absolutely. Credit insurance is a global product. Tradius and the other big players in the market are all global underwriters. So the same assessment would take place on a buyer, whether he's in Bangor or Bombay. It's a global product. And as companies look to look at new markets, credit insurance is there to help them to pick their steps and provide information.
Thank you. Okay, I'm just going to throw this one out there and you can decide who wants to answer this. Can credit insurance be restricted to one or two clients within a construction company's portfolio of work?
I'll take that one. Don't want to be greedy, but I'll take that one. Yes, the most cost-effective way of credit insurance is on a whole turnover basis because you've got a spread of risk rather than a concentration of risk. But the credit insurance can be tailored to suit the needs. And yes, while it is possible, it could possibly be the criteria would be a wee bit more stringent, shall we say, when you're looking to insure a small number of debtors as opposed to right across the sales ledger. But again, short answer is yes, that can be done.
Okay, great, thank you. Fran, I think this might be one for you. What can a company do if it has already lost its credit limit?
It's really all to do with dialogue. Get in touch with the underwriter if there's a story to be told. It's all about engagement. If a credit limit has been lost, it's more than likely due to the possibly losses that we're seeing in their year-end accounts. Can they provide an explanation behind the losses? It could have been a one-off contract. They're now back on track, sending in management accounts. Again, it's all about dialogue.
Okay. And you talk about the sort of effect that lockdown has had on the public sector, north and south. How important do you view that public sector spend to the sector in terms of credit insurance?
In the UK, it's pretty vital. There's a lot of infrastructure spend going ahead anyway. Construction, as we know, is one of the lead indicators of how the economy is performing. And there's been a lot of controversy over HS2 and the rights and wherefores of it all, but it is an absolutely massive project, which is designed to go on for a number of years. And so, as an industry, what that will bring is a lot of work, obviously, to the major PLCs, major construction companies, but also hopefully that will filter down to the smaller, medium-sized companies and the SMEs, where, like I say, particularly in the UK, the SMEs is where we have a number of insolvencies and where customers rely on us to protect their book because of the barriers to entry easy, etc. So public spend is key, and like I say, HS2 is a big project. It's not just that; it's Hinkley Point, Thames Link. They're all major investments, which, if going ahead, will what you're wrongly on whether they're correct or not. For the construction industry itself is a big bonus.
Okay, thanks for that, Kevin. Just when we're talking about big projects, somebody's asked the question: what effect did the failure of Carillion have on the sector? And that, you know, that obviously impacted a lot of supply chain across UK.
Yeah. I mean, it was the biggest corporate insolvency in UK construction ever. So Carillion did have a massive effect. The macro, as you say, Mark, had a knock-on effect with suppliers. Lots of redundancies, lots of jobs incomplete. The main, I suppose, one of the main issues for us as a credit insurer was that when Carillion actually failed, part of the reason why, as you'd understand, was a 500 million black hole in their finances. Now, the issue we have as an insurer is that day in, day out, in the UK again, and obviously elsewhere, we depend on management accounts to give us an up-to-date company's performing. And bear in mind the extensions to companies' house filings, you know, as Fran has said, 2 years is a long time. So we can't rely on that. We have to rely on later available information. But the issue being is if the audited accounts, and I think the big four all had a part to play in Carillion, whether it be advising, auditing, investment, whatever. If you've got an issue there, it does create a big problem for us. Like I say, justifying, or should I say, trying to understand that the management accounts and their authenticity is one thing, but if audited accounts are to be brought to task, it does create a big problem to us. The other thing, on the positive side of Carillion, I will say, is that as an insurer, they were involved, as you can imagine, in construction, a lot of joint ventures, and a lot of them did what they said they would, as a joint venture should do. It's joint and severally liable, and the partner took up the lease, or the lease, I should say, on it, and so a lot of them joint ventures, if not all, that we were covering, even though Carillion were apart, were and still are actually sometimes, some parts, continuing to trade in a normal way. So that was a positive for the industry.
Okay, so thank you. Nigel, a couple of ones, I think, specifically for yourself. Can Willis Towers Watson facilitate an engagement with credit insurers on our credit rating? I'm guessing that's a yes, and we'll be sharing your details after. Maybe you could give us a sense of what that engagement might look like.
Absolutely, we'd be delighted to help businesses engage with underwriters. There's maybe 13 or 14 active credit insurance underwriters writing cover on Northern Ireland businesses and across Ireland and the UK. So we have relationships with each and every underwriter. So, you know, instead of a customer or client having to engage with 13 separate, we'll facilitate that. We'll collect information and disseminate it across the underwriting market, and then provide our client with feedback and any further clarifications required on the figures of the information put forward. We will act as a post box in that matter as well. And if we need to arrange one-to-one engagement with the underwriters, we will do that. We know our way around the market. We have the experience. We have the relationships. So yeah, we can cut right to the decision makers.
Okay. You may or may not have an answer to this one. What are the ballpark cost ranges for each £1 million of cover?
That's a difficult answer. I'm not avoiding that, but there's all sorts of factors come into play when pricing credit insurance markets, quality of debtors, loss history, one thing or another. So everything goes into the mix to come up with the algorithm that finally churns out the price. But whoever answered that question or asked that question, rather, I'll be delighted to speak to them offline and provide them not only a ballpark figure but an accurate figure for of cost.
Grant. And again, another one specifically for yourself. Has Willis Towers Watson been able to assist companies in recovering their cover from credit insurers? So have you been able to turn things around?
Absolutely. You know, our day and daily, our team of specialists are doing this type of work for clients and non-clients. Now, you know, we don't always have a magic wand. It depends very much on maybe what the reason why the cover is withdrawal. But in most cases, we can get a process underway to have to eventually end up with a reinstatement of cover.
Great.
Yeah, can I come in there, Mark, as well? It's just sometimes I think we see that a withdrawal of cover is finality. It only is if the company unfortunately goes insolvent. A lot of the time, it could be that other information we require hasn't been provided, or we need up-to-date information. So, if a customer was to receive withdrawal notice, that can easily be overturned. Based on, you know, if we obtain the required information and we consider it, like I say, good enough to consider the company being creditworthy again. And that factor, can take a matter of, you know, minutes really. So the withdrawal of cover is a process, and sometimes, unfortunately, it's a process we use to try and extract the information from the business to be able to give a better, more informed decision because we've got more up-to-date information. So it's not, I mean, it is withdrawal cover, but there are avenues to be able to get that cover reinstated.
Mm-hmm. No, that's good clarification, Kevin. Thanks. Just one more question, unless I'll give a final warning here. If anybody else have any final questions, please do use the Q&A button there. But the final question I have at the moment is maybe for Fran. What can a company do if it expects to run into trouble paying its creditors on time? So I suppose that's, you know, timely advice. If you're facing that situation, what steps should you take at the minute?
Yeah, and it's something that we've seen, I suppose, more of last year, just with the, you know, the whole COVID thing. You know, again, engagement is key. You know, if we can help reschedule debt, you know, allow cash waivers for companies to aid them with temporary liquidity issues, because what we don't want to see is a loss on our books. So by allowing a company to continue to trade, to get through the difficulties, we should help all parties involved.
Mm-hmm. Excellent. That is all the questions I have in front of me, unless any of our speakers have any final comments they want to make. But I think it's been an incredibly useful run through. It's very timely as well, obviously, in the market we've had over the past year and indeed the year ahead. It's very important to get the right advice. So subsequent to this webinar, we'll be emailing all of our attendees with the contact details for Willis Towers Watson and Atradius. But it just remains for me to thank our three speakers very much. Very insightful. Thank Willis Towers Watson for their continued support as patrons, and Atradius for joining us today from the UK and Ireland. And we thank you all for attending and giving us your time today. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you, Mark.
Thank you, Mark.